Hello and welcome to another ETF trading video. This is Jeff Bish, president of MarketGauge.com, hoping to make your trading life easier by showing you how powerful it can be to trade country ETFs. Now, if you're not already watching this video in HD, you can probably do it with the settings gear icon down in the lower right hand corner. Just check the HD option, and it will be a lot clearer. So in this video, I'm going to show you a pattern that I really like for identifying longer term bottoms or longer term lows that we can trade against. And it's even better when a few technical factors come together and we've got some fundamental catalyst that can really make a market move. And so we've got all those things coming together in EWG, which is the ETF for Germany. So first, as you're looking at my charts, let me just explain what you're looking at. The magenta line is the 50-day moving average, and the gray line is the 200-day moving average. Now, if you're familiar with Market Gauge at all, you know that we look at the market in terms of market phases, and those phases are determined by the position, slope, and the price action around the 50 and the 200-day moving average. But I'm not going to cover that in this particular video. If you want to learn more about that, go to marketgauge.com /tutorials, or check out the little big view section of our site. What I'm going to focus on, though, does hinge or does leverage the position of the market relative to the 200-day moving average, right? So one of the patterns that I like to look for is a market that breaks through a major moving average like the 200, and then watch for the time when it comes back, corrects to that moving average for the first time. The first time means that it's been going down for a while, breaks through that down, usually the downward trend, and then once the moving average has flattened, or in this case, even better, turned up, the market tends to retrace to it. Now, that pattern may still be in effect if what I'm about to show you doesn't work out. In other words, if it does come down and retrace here and then bounce, that same pattern will still be in effect. So I might be a little early in calling this particular retracement because it didn't get all the way down there. However, that's not the pattern I'm focused on. It's just a bonus. The pattern I'm focused on is the fact that EWG established a very nice, clear range over the last several months. Now, it just so happens that that nice, clear range also sits in a very good location to believe that the range could break to the upside. Right, but it didn't break to the upside, it broke to the downside, and that's where the opportunity is. The pattern I want to highlight here is that when a market consolidates, and in this case, in a relatively bullish place, and then breaks the consolidation, rather than play it for a break to the downside, because it's in basically a pretty bullish location. That doesn't mean it can't roll over and continue to go lower. But the bigger opportunity here is that this breakdown is a big head fake. So how do you trade it as if it's a head fake? Well, first you need the breakdown. We got that 2 days closing below the level that was important, which is this 29.20 level. And I get that primarily by looking at the last time it tried to establish support against the range and where other support has come in. So if you look at that more closely, you'll come around the 29.20 and change. I round it down to 29.20. We've got 2 closes below it. It clearly broke, traded below there. And now what you want to look for is that head fake. And the head fake is simply that the market comes right back through it relatively quickly. And if it closes here today, I'm doing this live in the market. So if it closes back down below this level, then all bets are off. Unless tomorrow it goes back up through. So what I want to see it do is close above that 29.20 line that I have drawn in, and even better, close above the high of the bar that broke the resistance, or sorry, broke the support. So that's going to put it up here around the 29.40 level. Round that up to around 29.50, and the parameters for my trade are an entry around 29.50 and then a stop below this low. With the 200-day right here, 29.58, I'd round it down to 28.50. So risking $1 So if you think that's a wide stop, there's a couple things that you can do. One is 29.50 tells you that this is now a head fake, and you can see, wait, you might get the opportunity to buy a dip down to the 29.30 level. You could also tighten your stop to just under this low, and that would give you a much a tighter stop. But I prefer to play with wider parameters so I don't have to watch it as closely. And I don't know that the pullback will actually happen, but if it does, that's where it should hold, the 29.20 level again. All right. Now, I also don't think it's a wide stop because of my perspective. So let's make sure we're on the same page in terms of perspective. As I said earlier in the video, the consolidation here comes in a bullish location. Okay, so the fact that it broke out to the downside, for some might even be surprising, but never be surprised by the markets. Just play with what it gives you. If this proves to be a head fake, then the natural next step for this market would be for it to test the top end of the range. So if it tests the top end of the range, I will now be long down here, not worried about all the ups and downs on trying to buy the breakout. And that's where I prefer to get in if I can. And here's the potential opportunity. And I see the bigger picture here as a breakout to the upside and then a challenge of this high in here. So this 32 is really the target I'm focused on. So I see risking $1 with a nice wide range to give it some room with the eventual target of up around the 32 level. So in that case, I'm getting more than 2 to 1 in terms of my reward to risk. So it's important to have perspective on the trades. But when I trade the country ETFs, I like to give them a lot of room so the gaps don't necessarily matter. And also because the trends themselves tend to last longer. So if you can find opportunities like this particular pattern, a head fake at the bottom of a good range in an overall bullish condition, that's one that I like. So I hope that helps, and I'll see you in the next video.